Which business entity is best for you? During this webinar, you are about to discover how choosing the right entity can eliminate your liability and provide you massive tax benefits. What is a business entity? A business entity is a commercial, corporate, and/or other institution that is formed and administered as per commercial law in order to engage in business activities, usually for the sale of a product or a service. Basically, an entity is what allows you the ability by law to conduct business. There are many types of business entities defined in the legal systems of various countries. These include corporations, cooperatives, partnerships, sole traders, limited liability companies, and other specifically labeled types of entities. Each country has its own type of entities that can be filed for so a company can be created and operate. As you will learn today, one of the biggest differences between business entities is liability. With some entities, the business owner isn't liable for the business debts, while in other entities, the owner is liable. In other entities, only some parties involved are liable, and in other entities, the amount of liability differs from person to person. Another main difference between entities is in taxation. In some entities, the entity pays its own taxes, while in other entities, the profits or loss carry over to the individual business owners or partners' personal taxes. In the United States, the individual states incorporate most businesses. Very few special types are incorporated by the federal government. For federal tax purposes, the Internal Revenue Service, or IRS, has separate entity classification rules. Under the tax rules, an entity may be classified as a corporation, partnership, cooperative, or disregarded entity. Banks are one type of business that requires federal incorporation if they are using the word national in their name. Any bank chartered by the Office of the Comptroller of the Currency, or OCC, must have the word national in its name. A bank chartered by a state only is forbidden to have the word national in its name. For a savings bank or credit union, the key word is federal, and the same rules apply. A federally chartered savings bank or credit union must have the word federal in its name, while a state chartered savings bank or credit union cannot have federal in its name. Let's dive into state incorporated entities. A disregarded entity has one owner that is not recognized for tax purposes as an entity separate from its owner. Types of disregarded entities include single-member LLCs, qualified subchapter S subsidiaries, and qualified right subsidiaries, real estate investment trusts. A sole proprietorship is a business consisting of a single owner, not in a separately recognized business form. A sole proprietorship, also known as the sole trader or simply a proprietorship, is a type of business entity that is owned and run by one individual or one legal person, that is, Corporation LLC, and in which there is no legal distinction between the owner and the business. Basically, the person is the business in a sole proprietorship. With a sole proprietorship, the owner receives all profits, subject to taxation specific to the business, and has unlimited responsibility for all losses and debts. Every asset of the business is owned by the proprietor, and all debts of the business are the proprietor's. It is a sole proprietorship in contrast with partnerships, which have at least two owners. With a sole proprietorship, you are liable for your business debts because you are the business. A general partnership is a partnership in which all the partners are jointly liable for the debts of the partnership. It is a partnership in which partners share equally in both responsibility and liability. Liability for business debts is much the same as a sole proprietorship, but there are multiple partners involved instead of just one person. A general partnership refers to an association of persons or an unincorporated company with the following major features: created by agreement, proof of existence, and estoppel, formed by two or more persons, The owners are all personally liable for any legal actions and debts the company may face. Partnerships have certain default characteristics relating to both the relationship between the individual partners and the relationship between the partnership and the outside world. The former can generally be overridden by agreement between the partners, whereas the latter generally cannot be done. Think of a law practice where a named partner is an internal designation instead of related to the actual entity of the business. The assets of the business are owned on behalf of the partners, and they are each personally liable jointly for business debts, taxes, and liability. For example, if a partnership defaults on a payment to a creditor, the partner's personal assets are subject to attachment and liquidation to pay the creditor. By default, profits are shared equally among the partners. However, a partnership agreement will almost invariably expressly provide for the manner in which profits and losses are to be shared. Each general partner is deemed the agent of the partnership. Therefore, if that partner is apparently carrying on partnership business, all general partners can be held liable for his dealings with third persons. By default, a partnership will terminate upon the death, disability, or even withdrawal of any one partner. However, most partnership agreements provide for these types of events, with the share of the departed partner usually being purchased by the remaining partners in the partnership. By default, each general partner has an equal right to participate in the management and control of the business. Disagreements in the ordinary course of partnership business are decided by a majority of the partners, and disagreements of extraordinary matters and amendments to the partnership agreement require the consent of all partners. However, in a partnership of any size, the partnership agreement will provide for certain electees to manage the partnership along the lines of a company board. A limited partnership is a partnership where at least one partner has unlimited liability and one or more partners have limited liability. A limited partnership is a form of partnership similar to a general partnership, except that in addition to one or more general partners, or GPs, there are one or more limited partners. It is a partnership in which only one partner is required to be a general partner. Like shareholders in a corporation, limited partners have limited liability. This means they have no management authority and are only liable on debts incurred by the firm to the extent of their registered investment. The GPs pay the LPs a return on their investment, similar to a dividend, the nature and extent of which is usually defined in the partnership agreement. General partners thus carry more liability, and in cases of financial loss, the GPs will be the ones which are liable. Limited partnerships are distinct from limited liability partnerships, in which all partners have limited liability. In some jurisdictions, the limited liability of the LPs is contingent on their not participating in management. A limited liability partnership is a partnership where a partner's liability for the debts of the partnership is limited, except in the case of liability for acts of professional negligence or malpractice. In some states, LLPs may only be formed for purposes of practicing a licensed profession, typically attorneys, accountants, and architects. This is often the only form of limited partnership allowed for law firms, as opposed to general partnerships. A limited liability partnership, LLP, is a partnership in which some or all partners, depending on the jurisdiction, have limited liabilities. It therefore exhibits elements of partnerships and corporations. In an LLP, one partner is not responsible or liable for another partner's misconduct or negligence. This is an important difference from the traditional unlimited partnership, in which each partner has joint liability. In an LLP, some partners have a form of limited liability similar to that of the shareholders of a corporation. In most cases, an LLP must also have at least one general partner with unlimited liability. Unlike corporate shareholders, the partners have the right to manage the business directly. In contrast, corporate shareholders have to elect a board of directors under the laws of various state charters. Limited Liability Partnership, LLP. With a limited liability partnership, the board organizes itself also under the laws of the various state charters and hires corporate officers who then have as corporate individuals the legal responsibility to manage the corporation in the corporation's best interest. An LLP also contains a different level of tax liability from that of a corporation. Limited liability partnerships are distinct from limited partnerships in some countries, which may allow all LLP partners to have limited liability, while a limited partnership may require at least one unlimited partner and allow others to assume the role of a passive and limited liability investor. A limited liability limited partnership is a combination of LP and LLP available in some states. The limited liability limited partnership, LLLP, is a relatively new modification of the limited partnership. An LLLP is a limited partnership and as such consists of one or more general partners and one or more limited partners. The general partners manage the LLLP, while typically the limited partners only have a financial interest. The difference between an LLLP and a traditional limited partnership lies in the general partner's liability for the debts and obligations of the limited partnership. In a traditional limited partnership, the general partners are jointly liable for its debts and obligations. Limited partners are not liable for those debts and obligations beyond the amount of their capital contributions. In an LLLP, by having the limited partnership make an election under state law, the general partners are afforded limited liability for the debts and obligations of the limited partnership that arise during the period that the LLLP election is in place. Because the LLLP is so new, its use is not widespread. Arkansas, Arizona, Colorado, Delaware, Florida, Georgia, Maryland, Nevada, Texas, and Kentucky have all adopted statutes that allow formation of an LLLP, usually as a conversion of an existing limited partnership. The general partners might want to do this to reduce their legal liability. LLLPs are most common in the real estate business. There are significant questions about whether the limited liability provided to general partners by the LLLP election will be effective in states that do not have an LLLP statute. A limited liability company, or LLC, is a form of business whose owners enjoy limited liability, but which is not a corporation. A limited liability company is a flexible form of enterprise that blends elements of partnership and corporate structures. An LLC is not a corporation. It is a legal form of company that provides limited liability to its owners. LLCs do not need to be organized for profit. In certain U.S. states, businesses that provide professional services requiring a state professional license, such as legal or medical services, may not be allowed to form an LLC, but required to form a very similar entity called a Professional Limited Liability Company, or PLLC. A limited liability company, LLC, is a hybrid business entity having certain characteristics of both a corporation and a partnership or sole proprietorship, depending on how many owners there are. An LLC, although a business entity, is a type of unincorporated association and is not a corporation. The primary characteristic an LLC shares with a corporation is limited liability, and the primary characteristic it shares with a partnership is the availability of pass-through income taxation. It is often more flexible than a corporation, and it is well suited for companies with a single owner. For U.S. federal income tax purposes, an LLC is treated by default as a pass-through entity. If there is only one member in the company, the LLC is treated as a disregarded entity for tax purposes, and an individual owner would report the LLC's income or loss on Schedule C of his or her individual tax return. Thus, income from the LLC is taxed at the individual tax rates. The default tax status for LLCs with multiple members is as a partnership, which is required to report income and loss. Under partnership tax treatment, each member of the LLC, as is the case for all partners of a partnership, annually receives a Form K-1 reporting the member's distributive share of the LLC's income or loss that is then reported on the member's individual income tax return. On the other hand, income from corporations is taxed twice, once at the corporate entity level and again when distributed to shareholders. Thus, more tax savings often results if a business formed as an LLC rather than a corporation. Some states do not allow certain professionals to form an LLC that would limit the liability that results from the services the professional provides. Some of these professions include doctors and other medical care, lawyers and legal advice, accountants and other accounting services. Instead, states allow a professional limited liability company, or in the LLC statutes, the liability limitation only applies to the business side, such as creditors of the company, as opposed to the service side, the level of medical care, legal services, or accounting provided to clients. This is meant to maintain the higher ethical standards that these professionals have committed themselves to by becoming licensed in their profession and not immune to malpractice suits. A corporation is a separate legal entity that has been incorporated either directly through legislation or through a registration process established by law. Incorporated entities have legal rights and liabilities that are distinct from their employees, shareholders, and members, and may conduct business as either a profit-seeking business or not-for-profit. Despite not being human beings, corporations, as far as the law is concerned, are legal persons and have many of the same rights and responsibilities as natural people do. Corporations can exercise human rights against real individuals in the state, and they can themselves be responsible for human rights violations. Corporations can be dissolved, either by statutory operation, order of court, or voluntary action on the part of shareholders. Insolvency may result in a form of corporate failure when creditors force the liquidation and dissolution of the corporation under court order, but it most often results in restructuring of corporate holdings. Corporations can even be convicted of criminal offenses, such as fraud and manslaughter. However, corporations are not considered living entities in the way that humans are. A corporation may either be a subchapter S corporation or a corporation. An S corporation is a corporation that makes a valid election to be taxed under subchapter S of Chapter 1 of the Internal Revenue Code. In general, S corporations do not pay any federal income taxes. Instead, the corporation's income or losses are divided among and passed through to its shareholders. The shareholders must then report the income or loss on their own individual income tax returns. S corporations are ordinary business corporations that elect to pass corporate income, losses, deductions, and credit through to their shareholders for federal tax purposes. S status combines the legal environment of C corporations with U.S. federal income taxation similar to that of partnerships. Like a C corporation, an S corporation is generally a corporation under the law of the state in which the entity is organized. Taxation of S corporations resembles that of partnerships. As with partnerships, the income, deductions, and tax credits of an S corporation flow through to the shareholders annually, regardless of whether distributions are made. Thus, income is taxed at the shareholder level and not at the corporate level. Payments to S shareholders by the corporation are distributed tax-free to the extent that the distributed earnings were previously taxed. Also, certain corporate penalty taxes, that is, accumulated earnings tax, personal holding company tax, and the alternative minimum tax do not apply to an S corporation. Unlike a C corporation, an S corporation is not subject to the 10% of taxable income limitation applicable to charitable contribution deductions. In order to make an election to be treated as an S corporation, the corporation must be a liability entity, a domestic corporation which has elected to be taxed as a corporation, must have only one class of stock, must not have more than 100 shareholders. Shareholders must be U.S. citizens or residents. Profits and losses must be allocated to the shareholders proportionately to each one's interest in the business. C corporations refer to any corporation that is taxed separately from its owners. A C corporation is distinguished from an S corporation, which generally is not taxed separately. Most major companies and many smaller companies are treated as C corporations for U.S. federal income tax purposes. Professional corporations are those corporate entities for which many corporation statutes make special provision, regulating the use of the corporate form by licensed professionals such as attorneys, architects, engineers, public accountants, and physicians. Legal regulations applying to professional corporations typically differ in important ways from those applying to other corporations. Professional corporations, which may have a single director or multiple directors, do not usually afford that person or persons the same degree of limitation of liability as ordinary business corporations. Such corporations must identify themselves as professional corporations by including PC or P.C. after the firm's name. Professional corporations often exist as part of a larger, more complicated legal entity. For example, a law firm or medical practice might be organized as a partnership of several or many professional corporations. Doing business as, or DBA, denotes a business name used by a person or entity that is different from the person's or entity's true name. Filing rudiments vary and are not permitted for some types of businesses or professional practices. DBAs can be sole proprietorships or can be used by corporate entities to reserve brand names, such as those of chain stores owned and operated by a holding company or other umbrella. The phrase doing business as is a legal term used in the United States and Canada, meaning that the trade name or fictitious business name under which the business or operation is conducted and presented to the world is not the legal name of the legal person or persons who actually owns the business and is responsible for it. The distinction between an actual and a fictitious name is important because businesses with fictitious names give no obvious indication of the entity that is legally responsible for their operation. Fictitious names do not create legal entities in and of themselves. They are merely names assumed by existing persons or entities. Any entity can apply and build business credit. But by default, due to entity structure, with many entities, the business owner will always be liable whether they provide a personal guarantee or not. To truly eliminate liability, a corporation or LLC is best. Partnerships and sole proprietorships by default require owners and partners to be liable for their business debts. Contact us today to learn more about choosing the right entity for your business. Limited partnerships are distinct from limited liability partnerships, in which all